Hi, and welcome to this week's Market Insights video and a look at what lies ahead for us. Well, several key data releases and central bank decisions are all scheduled for this week, offering fresh information on labour trends, inflation and policy direction across major economies. Now, the first key event of the week is the UK unemployment report. That's coming out on the 16th of December at 9 a.m. GMT +2. Now, the unemployment rate rose to 5% in Q3 2025, the highest since the period covering December 2020 to February 2021, and slightly above expectations of 4.9%. Now, the number of unemployed increased by 117,000 to 1.789 million. Now, that was driven mostly by people who've been out of work for either less than 6 months or more than a year. Total employment dropped by 22,000 to 34.192 million, marking the first decline since early 2024. That was mainly down to fewer full-time job positions. Some analysts point to higher tax burdens for the small businesses as a factor limiting job creation. There's been an awful lot of talk about that in the UK in the recent months. Now, the report comes out just 2 days before the Bank of England interest rate decision on the 18th. Markets expect a 25 basis point cut, and it's unlikely the Bank of England will change course based solely on this data coming out. However, as we saw last time, the release could still trigger some short-term volatility. Weak job numbers could increase expectations of more Bank of England cuts in 2026 and weigh on the Great British Pound. Okay, next up, and we move to the US. Nonfarm payrolls and the unemployment rate will be released on the 16th of December at 3:30 p.m. GMT +2. Now, because of the government shutdown that we had earlier on this year, US labour data has been delayed and is now coming mid-month instead of the usual first Friday. In September, non-farm payrolls increased by 119,000, rebounding from a 4,000 decline, revised figure, in August and beating expectations of 50,000. It's the biggest job rise in 5 months. But despite that, the unemployment rate ticked up to 4.4%. That's the highest since October 2021. Now, even with strong payroll numbers, the mixed picture, especially the upward move in the unemployment rate, weakened the US dollar at the time. This month, we'll finally also receive the November labour report. Again, because of those previous delays due to the shutdown, markets are highly sensitive to fresh employment data, so volatility is likely to be elevated again. Do pay attention to the revisions in September's data as well, and don't forget your risk management techniques, because it could be a choppy time. Okay, now sticking in the US, and it's the US inflation numbers that are up next, coming out on the 18th of December at 3:30 p.m. GMT +2. Now, the last CPI report showed a 0.3% monthly increase, pushing annual inflation to 3%, both lower than expected. Now, core CPI rose 0.2% on the month, also bringing the yearly figure to 3%. A 4.1% jump in gasoline prices was the biggest contributor. Otherwise, inflation pressures, to be fair, were fairly muted. Now, the softer inflation outlook previously reinforced expectations of a Fed rate cut, weakening the US dollar and boosting the equity markets. At its last meeting, the Fed delivered a hawkish cut, reducing rates to support a softening labour market while signalling caution about further easing. Now, if this inflation report hints at the need for more cuts, expect another burst of volatility where gold and tech stocks will be potentially supported, while a hotter print may strengthen the US dollar and put some pressure on indices like the S&P 500. Right, now to Japan, which usually keeps markets calm as it rarely changes rate. The last hike was in January 2025. Now, according to reports, the Bank of Japan interest rate decision is coming up, and officials see a strong chance of raising the benchmark rate by 25 basis points to 0.75% at their meeting ending on the 19th of December. Now, if confirmed, it will be Japan's highest policy rate since 1995. Markets will pay close attention not just to the decision, but to hints about future hikes. There's also a political angle. New Prime Minister Sanae Takaichi is known for supporting monetary easing, but sources say the government won't block the Bank of Japan if it decides to raise rates this month. Now, forward guidance may be more important than the hike itself, since the move is most likely priced in. A more hawkish tone could strengthen the Japanese yen, while a cautious stance may weaken the yen and push the Nikkei 225 higher. So, to sum up, this week is all about central bank signals, inflation trends and labour market data. With multiple high-impact releases packed into a few days, volatility is almost certain. So stay sharp and don't forget your risk management techniques. Keep up to date as well. Check out the news and analysis section on the FX Open website. Well, that's it for now, so we wish you luck with your trading in the week ahead.